Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I'm going to discuss what I view as the best 5 REITs to buy for May of 2025. The REIT market has been quite volatile lately and it's resulting in some interesting buying opportunities. But before I get started, can you please do me a huge favor and click the like button, subscribe to the channel, helps me a lot to keep on growing. I really appreciate it. Thanks so much in advance. So the first REIT I'm going to discuss is called First Industrial, ticker symbol FR. This is an industrial REIT that I've covered a few times on this channel because it's our largest industrial REIT investment, and today I'm going to give you a quick update. First interesting thing to note here is that it's one of the biggest investments of the leading REIT activist investment firm called Land and Building. They have an amazing track record. I hold them in high regard. I generally think that they're good REIT investors, and this is one of their largest investments, which speaks a lot for the conviction in this company. And I think the reason why they're investing so heavily in it is because this industrial REIT owns arguably the best assets in the industrial peer group, and yet the REIT trades at one of the lowest valuations of the peer group. So there is a significant mismatch between the valuation and the fundamentals of the REIT. Its valuation is today historically low, trading at about 16.5 times FFO. This may not seem particularly low to some of you who are used to buying REITs like EPR properties that trade at closer to 10 times FFO. But what you need to keep in mind here is that this is a REIT that's enjoying very rapid growth prospects. And one of the main reasons why it's enjoying such rapid growth prospects is because the rents in its leases are deeply below market. What happened is that the REIT signed a lot of long-term leases with 10 to 15 years terms long time ago. And these leases included rent escalators of 2 to 3% annually, but market rents grew much faster than that. And as a result, its lease rates fell below market. And as a result, now the REIT has a great opportunity to bump up its rents significantly as its leases gradually expire. In the most recent quarter, its releasing spreads were about 30%. Over the past many years, they have typically been between 30 to 50%. So it's able to bump up its rents very significantly as its leases expire, and this will remain a significant growth tailwind for the coming years. And so the 16.5 times FFO is based on the lease rates that are deeply below market. If you adjusted the rents to market levels, its FFO multiple will drop closer to about 12 times FFO. And I think that 16 times is already too low for an industrial REIT of this quality, and 12 will be I just don't see that happening. It doesn't make sense to me. And so this is leading into very attractive organic growth prospects. The REIT has guided for 6 to 7% same property NOI growth this year, even despite the difficult environment we're in with the trade war, potential recession in the horizon. And then on top of this organic growth, the REIT also enjoys additional growth as it owns a significant land bank and it's developing this land, earning high returns on its invested capital. It just broke down on 2 new projects, one in Dallas, one in Philadelphia. It's expecting roughly 8% initial yields on these properties. So it's creating a lot of value because these assets, if you bought them in the private market, once they are stabilized, they'll probably sell at cap rates in the fives, probably mid fives, and yet they are developing them at 8% cap rate. So it's creating a lot of value. It's also resulting in a positive spread over the cost of capital. And so all in all, I expect First Industrial to grow its FFO per share at a high single-digit, low double-digit growth rate over the coming years. And when you take that into account, 16.5 times FFO is actually a pretty low multiple, especially considering that this REIT has a very good management team. They have an amazing track record. They have massively outperformed the market over the long run. They also have a very strong balance sheet with relatively low debt, long debt maturity, so no major impact from the surge in interest rates. This type of REITs typically trade at closer to 25 times FFO, 30 times FFO, and this has also been true for First Industrial for most of its last 5 years, and yet today you can buy it at a steep discount relative to that. Why is it so cheap? The surge in interest rates, the fears of oversupply in the industrial sector, and well, the trade war of course doesn't help either because this property sector is perceived to be somewhat more cyclical. But I think that First Industrial is not going to be severely impacted by these risks because, again, as I said earlier, it has a very strong balance sheet. It owns high quality assets in supply constrained markets, and its lease rates are deeply below market already, which provides a path to growth but also provides margin of safety in case we go into a recession. The low valuation of course helps as well. And so I think that ultimately this is why Land and Building is so heavily investing in this specific REIT, and we agree with them that this is a great opportunity, and it's our biggest industrial REIT investment as well at High Yield Landlord. By the way, if you want to access our full portfolio, you can join our REIT newsletter for 2-week free trial. Will be the first link in the description of this video. Okay, the second company I'm now gonna discuss is called Patria Investments, ticker symbol PAX. This company is not officially structured as a REIT, but it's what we call a REIT adjacent business, in that it's heavily involved in the REIT sector. It's essentially the Blackstone of Latin America. It's a major alternative asset manager, meaning that it's going to help other investment firms invest in this region of the world and earn fee income in exchange of its asset management services. And what's interesting for us as REIT investors is that Patria is the biggest REIT asset manager in Latin America. It's a very big REIT asset manager in Brazil, to be more specific. It manages over 10 REITs there, but it's now replicating the same business model elsewhere in Latin America, and to be more specific, in Colombia, in Chile, and also in Mexico. We think that this business has great potential because it's growing at a very rapid pace. The company has guided to grow its fee-related income by about 25% annually over the next 3 years. It just recently reaffirmed its guidance, even noted that they're growing increasingly confident in reaching this guidance, even despite the trade war. Yet, the share price of the company has dropped quite a bit lately, and therefore I think that now is a good time to buy more of it as we go into May of 2025. The market seems to think that this company is going to suffer from the trade war, given that many Latin American companies have also been impacted by tariffs, but I actually think that this might end up benefiting Latin America because it will accelerate the trend of nearshoring, with more and more companies moving their supply chains from China to countries like Mexico or Brazil, and more friendly Latin American countries that are in closer proximity to the US, where labor is also cheaper than China these days. You know, China is today the main target of the trade war. They are facing 145% tariffs, I think is the latest. I think that some products are even hit with 245% tariffs. And so, yet compared to that, Latin American countries have very low tariffs in place. And even despite being impacted by tariffs, Mexico as an example is impacted by 25% tariffs. It's still a lot cheaper to produce goods in Mexico than in the US. And so I think that this will actually benefit Patria over the long run. It will accelerate the growth of nearshoring, and so it doesn't make sense, in my opinion, for the share price of the company to have dropped so much over the last few quarters. The company just reaffirmed its multi-year guidance, said that it's increasingly confident in meeting it. So clearly no impact from the trade war. Yet its valuation is about 3 times lower than that of Blackstone today. I of course appreciate the fact that Latin America is a riskier region of the world, and so it should be priced at a discount, but I think that the discount is way excessive here when you consider that Patria is expected to grow at a faster pace than Blackstone over the long run. It has lower leverage than Blackstone as well, and also the Latin America risk is well mitigated by the fact that most of its fee income is actually earned in hard currencies like the US dollar, the euro, or the British sterling. And it's well diversified by asset type, by country. Most of its institutional investors are global investors as well. They are tied to Patria on the long-term contracts, which is resulting in very consistent and predictable income despite operating in a more uncertain market. So again, I think that the discount is just way excessive, and given how well the company has executed since going public, it doesn't make sense that it's trading at such an insanely low multiple of less than 10 times its fee-related income. I think that even if it priced at a 2 times lower multiple than Blackstone, it could nearly double in value. And while you wait, you're earning a 5.5% dividend yield. The company is expected to keep growing its cash flow and its value by about 20-25% per year. And so ultimately, I think that the risk reward is very attractive here, and especially so in the context of a portfolio. If you want to diversify geographically and have some exposure to Latin America, I cannot think of a better way than buying Patria, and this is why it's my biggest investment in this region of the world, and one of my only investments in this region of the world. Alright, the third company that I'm going to discuss now is called KKR Real Estate Finance, ticker symbol KREF. However, note that I'm not referring to its common equity, I'm referring to its Series A preferred equity. That's what I've been buying now in the recent weeks. Generally speaking, as you know, as I've discussed many times on this channel, I'm not a big fan of mortgage REITs like KKR Real Estate Finance. I think that they're too heavily dependent on macro factors that are out of their control, like interest rates and spreads. The volatility in these macro factors can make or break their businesses, and I don't like to be so heavily reliant on macro stories. However, I like the preferred equity here because it has dropped quite a bit in recent weeks and now trade at a 30% discount to par. It's offering a near 9% dividend yield, which I think is sustainable, is unlikely to be cut, and so the risk reward is quite attractive. The market seems to worry here is that the trade war could lead to higher construction costs, hurting some of the development projects against which this mortgage REIT has lended money. And this is a fair concern. However, what the market might have overlooked here is that the vast majority of the loan portfolio of KKR Real Estate Finance is collateralized by stabilized buildings. So its development exposure is only about 10% or something like that. It's relatively low. And so even if it suffers some losses on those, it really shouldn't have such a big impact on the entire company. I think that the common equity is quite risky because it's heavily leveraged. It's externally managed as well, which leads to some conflicts of interest. But overall, I think that the company is very unlikely to go under. Most of their collateral is multifamily, industrial. These are high quality properties. They have a little bit of office exposure, but these are Class A long-let properties, so no major near-term risks. And so ultimately, I think that the portfolio should do well enough to pay the preferred dividend, which enjoys the buffer of the common dividend. Remember that preferred dividends are senior to the common dividend. The common dividend cannot earn a penny before the preferred dividend is paid in full. So this is a great risk mitigator, and yet you're getting a 9% dividend yield and trading at a 30% discount to par. I think that over time, as the market environment improves and the risks go down, the market is likely to reprice these preferred shares at closer to par value, which is $25 per share. This could also lead to 30-40% upside from here in a best case scenario. So you're not only getting a high yield, but you could also get some upside over the coming years. The final thing that I want to note that I think is quite interesting is that it's managed by the private equity powerhouse KKR. They themselves own a significant stake in this mortgage REIT. It's about 15%. They own about 15% of the common equity, and they have big plans for it. They want to grow the size of the loan portfolio in order to grow their fee income that they earn from it. And I think that this is actually a significant risk mitigator for the preferred equity, because I think that even if we face the worst case scenario where this mortgage REIT was facing severe losses and was at risk of going under, I would expect KKR, the manager, to step in and serve as a lender of last resort to save the mortgage REIT, because they are in it for the long run and they wouldn't want these mortgage REITs to go under because of some temporary issue that we'll be facing because of a temporary liquidity issue. So I think that this is a significant risk mitigator the market is today overlooking. So taking all of this into account, this is one of my favorite investment opportunities in the preferred equity segment of the market now going into May of 2025. And for these reasons, we recently bought more shares at High Yield Landlord. The fourth company that I think is quite attractive at the moment is called Safehold, ticker symbol SAFE. This is the only REIT that specializes in ground leases. And what those are, in case you're not familiar, ground leases are land investments. And so you're buying the land and then you're leasing it to typically a real estate developer that will build improvements on the land. The lease term is typically very long at 99 years initially. They include annual rent escalations. The tenant is obviously responsible for the improvements, the maintenance of these improvements. And then once the lease expires after 99 years, all the improvements, so the building reverts back to the landowner at no cost. And so it can have pros and cons, obviously, but typically, in many cases, it can be a win-win for both parties, the landowner, so the ground lease investor, and the tenant. The tenant benefits by not having to invest as much since they don't have to buy the land, and so this can result in higher returns on invested capital during these 99 years at least. And the landowner is getting the improvements for free after the lease term ends, and it's getting a very safe yield during the lease term. And it's very safe because if the tenant defaults on the lease, they also get the improvements at no cost in most cases. But one downside, but also an advantage of these ground leases is that they are very sensitive to interest rates. They are very long duration assets, and so if interest rates rise, the stock price of Safehold will crash. But this also means that if interest rates go down, Safehold could soar a lot higher. And over the past few years, we've seen Safehold crash very significantly. Its share price has cut down to about just a third of what it was at its peak, and this was entirely due to the surge in interest rates. But I think that one consequence of all this trade war, that this tariff drama that we've had lately, is that it will weaken the economy. I think that we are likely headed into a recession, and I think that this will ultimately lead to quite a bit lower interest rates, and this should benefit Safehold because it's recession resistant. I don't think that we're going to see any ground lease defaults, and even if we do, this would actually benefit Safehold since it will get these improvements at no additional cost. And I think that the low interest rates will greatly improve its market sentiment and lead to a materially higher valuation. Yet the market doesn't seem to have realized this, as its share price has dropped along with other REITs following this recent trade war. So I think it's quite an attractive time to buy more shares of Safehold for this reason. And then the fifth and final company that I'm going to discuss now is called Armada Hoffler Properties, ticker symbol AHH. This is a small cap diversified REIT that has a bit more leverage than the average of the REIT sector. It also recently cut its dividend. The market obviously hates that. Because of that, its market sentiment has suffered a lot. And as we had a lot of volatility lately and the stock market sold off, Armada Hoffler dropped even more than the rest. But I think that even before this recent drop, it was already very heavily discounted. So now it's just too hard to resist, in my opinion, and I'm planning to buy a bit more of it because trading at just about 6.5 times FFO, a near 50% discount to our estimate of the value of its properties. And the long-term prospects of its portfolio are quite attractive in my opinion. I think that the dividend cut, while it hurts market sentiment of the short term, is actually going to be beneficial to long-term oriented shareholders because now giving the REIT enough retained cash flow to gradually deleverage, potentially also buy back shares, complete its development projects. So it's going to lower risks, it's going to create value over time. And yet most investors hate it right now because they've been selling the stock irrespective of its fundamentals simply because they felt betrayed by the management team. I actually think that the REIT is well managed. The management own a significant stake in the REIT. They're some of the biggest shareholders. They did an amazing job up until the pandemic. They had significantly outperformed the average of the REIT sector, but then came the pandemic that hurt the market sentiment of office sector. They have some office exposure, and then we had the surge in interest rates. They had a bit more leverage than the rest, so they've been quite unlucky with the market conditions over the past 5 years. But overall, in my opinion, this is a high quality REIT. I like most of their assets, even the office properties. These are modern mixed-use properties that have long-term leases, a relatively high-quality tenants. I'm not worried about the office properties. And the rest of the portfolio is multifamily and retail that's very high quality, doing really well. Again, very often mixed-use properties, which are very desirable. And so this is just a case of the valuation being dirt cheap for what I view as high quality assets. There's been some short-term pain, and I don't deny that. But over the long run, if you look now 5 years from now, 10 years from now, I expect the share price to be much higher just simply because of how low the valuation has gotten. And so for this reason, I think that I'm likely to buy more shares of it as we go into May of 2025. Now, let me know in the comment section below what other REITs you're buying at the moment. I'm very curious. Let me know also if you have any questions regarding these 5 REITs or any other that you're interested in. I'll be happy to answer your questions in the comment section. Once more, if you could please click the like button, subscribe to your channel. It helps me a lot to keep on growing, and I really appreciate it. Thanks so much. I'll see you at my next one. Bye-bye.